February is here, if you can believe it, guys, and you're wondering, what stock should I buy now? I've got you covered with 10 stock picks to explore. Now, this is a wide mix of stocks, from hyper growth stocks to dividend growth stocks. And we have to be careful because the Fed's gonna be raising rates this week, plus we have big cap tech earnings. Now, several of these companies have already reported earnings and given us guidance, so we know where they're at. But there are a few stocks in this list that have not reported earnings yet that could be opportunities on pullbacks in February. So I'm gonna go through 10 stock picks, very diverse list. Some have dividends, some don't, large cap, small cap, give you a high level overview of each company, and then talk about potential price areas where I might add to my long-term investing portfolio. Several of these are on my watch list, and I think all 10 of these stocks could be great long-term investments. I'm excited to bring this to you guys. Without further ado, let's dig in. Let's get this party started, guys. The first stock, these are not in any particular order, is ASML. Now, this is an expensive stock. It's trading around a 43 PE ratio. It's not crazy expensive, but it's not cheap, and it has run pretty hard from its lows. Dividend, though, it pays a dividend of 1.25%. This is a DGIF stock. Market cap is $260 billion. It's pretty large. So ASML, guys, of course, it's one of the world's leading manufacturers of chip making equipment. So this is an equipment manufacturer. There's a common misconception that they actually make semiconductors or chips, but they do not. They design and manufacture the machines that are essential in chip manufacturing. And when you think of ASML, the reason that people are so bullish on this stock is because it has quite a bit of a moat. Now, China is going to start making competitive products to ASML, but there's a couple things. Number one, it's still a long ways out. And number two, China's probably just going to use that equipment for themselves. And they're not able to buy this equipment. There's a lot of geopolitical drama going on with this, and you guys know the backdrop. But they have a unique competitive advantage when it comes to patent-protected EUV capabilities, which have helped the company essentially create a legal monopoly in the space. As a result, ASML is well positioned to continue growing and dominating the industry for years to come, backed by its ever-growing backlog. Now, ASML did report earnings recently, so we have a handle on what's going on here. Their GAAP EPS was 460 in euros, beat by 0.27. Revenue is 6.4 billion. That was a 28.5% year-over-year increase, and that beat by 50 million. Gross margin, 51.5%. 2023 net sales, they expect 25% compared to 2022, and a slight improvement in gross margin. And for net sales, they expect 6.1 to 6.5 billion, and gross margin between 49 and 50%. Overall, very solid. Of course, with semiconductors, we might have a little bit of a slowdown here, and it's hard to predict. I think a lot of the guidance that we're getting is very uncertain. So with this stock, I think it's run pretty hard. You have to be careful chasing it, but I like this especially on any pullback. Now, the second stock on the list, guys, is Enphase, leading energy solutions company in the world. Founded in 2006, they have 2,834 employees as of September 30th, 2022, more than 2.7 million systems in more than 145 countries. This stock is an ultimate rabbit hole, so I'm not going to cover it in too much detail. If you want a deep dive, drop a comment below. So Enphase is trading right now at about $216 a share. It's not cheap, guys. It's about 103 PE ratio. Now, this stock got down to $118.50 on the 52-week low, 52-week high, $339.92. So of course it's bounced hard. It's also somewhere in the middle between its low and its high, and you have to be careful chasing it, but it has pulled back quite a bit. A couple key things here, guys. Short interest, 4.41%. Also, earnings are coming up here February 7th. Now, Goldman reduced their price target from 379 to 327. That's still quite a bit of upside from here, but what I would do personally, this is on my watch list, and I'm going to look for this stock to pull back, hopefully below $200 per share. Now, you saw the PE ratio is over 100. I also want to look at a price to sales. It's 15.4, so pretty expensive. Now, if you look at this, though, it was all the way up here to 26. It's come back quite a bit. This is one of those companies that's really in hyper growth mode, and so I think it can grow into its valuation pretty quickly, but you have to be careful because it's not an inexpensive stock. Now, one last thing that's really interesting about Enphase is that it's listed under the industry here, semiconductors and semiconductor equipment. A lot of people own this stock and they don't even understand what the company does. So from a high level, the company offers semiconductor-based microinverters, which convert energy at the individual solar module level, and they combine that with proprietary networking software technologies, so it provides energy monitoring and control services. It also offers AC battery storage systems and so on. Located in Fremont, California. Check this one out, guys. Ticker is ENPH. Now, this third stock is also one that people don't often understand. It's Palo Alto Networks. A lot of people mix it up and they say it's a SaaS company. It's software as a service. Now, it does have a component that's SaaS based, but only about 50% of the company's revenue comes from software as a service. But this is a cybersecurity company. It's very different than you look at like a CrowdStrike that does endpoint security and that's built in the cloud for the cloud, software as a service. This is Palo Alto Networks, PANW. It doesn't have a PE ratio, large cap, $47.6 billion. Now, the 52-week low was $132 and the 52-week high was $213. Now, I like this stock and I've been saying it for a while on Discord. I like this stock below 150, preferably $130 to $140. It got to 132. I personally did not add. They report earnings on February 20th, and I would like to add this stock under $150, somewhere between $140 and $150 after I see earnings and how they're doing. Because this business is hybrid, I need to understand the earnings report and what's going on and what the demand is. Do we have deterioration there, or is it insulated because it's cybersecurity? I need to have a better handle on the earnings before I buy the stock. Because the thing about Palo Alto, when we think of cybersecurity, it offers firewall appliances and software. It has security management services. This is a very, very diverse company. You can see here it's got SaaS security API, SaaS security inline, as well as threat intelligence. So where CrowdStrike just focuses on endpoint security, these guys focus on all sorts of different areas within that cybersecurity puzzle. But they also have consulting services, professional services, architecture, design and planning, implementation, configuration. So this has a lot of services and it can have some more peaks and valleys. And I do like the stock. There's a chance they have a great earnings and the stock just rips higher. But me personally, I want to see earnings. And if it does pull back below 150, that's where I'd consider adding it. I hope this is helpful so far, guys. Before I go on, please do me a favor, subscribe to the channel and click that bell to get notifications. I'm trying to grow this channel to over 40,000 subscribers in 2023, and you can help me out by subscribing today. I also want to point out that several of the stocks on this video are on my personal watch list. Now you can see that watch list and the exact prices I want to buy these stocks at, as well as my actual buys and sells real time by joining Discord, and you can join that by visiting patreon.com/firedupwealth. So the fourth one, guys, very similar situation to number 3. This is Bill.com, and these guys report earnings just in a couple of days here on February 2nd. Now, it's trading right now at $114 a share. 52-week low is $89.87. The 52-week high, $267.17. This is one that's also thrown in that SaaS bucket, but it is not true software as a service built in the cloud for the cloud. This is much more usage and consumption based, so more like a snowflake where it relies on people using it. It's transactions. So this has a combination as well. It's trading at $114 a share and it's not going to have a PE ratio. You're going to use something like an EV NCM revenue. So some of the metrics on this, currently it's the 7th most expensive stock in the SaaS universe that I cover. It's trading just over 11x on the EV NCM revenue. Now this is hyper growth, 143%. For the LTM growth, 143%. Gross margins are 79%, and it does have free cash flow margin, but just barely 2%. Although it is cloud-based software that simplifies, digitizes, and automates back office financial operations for small and mid-sized businesses. You have to remember that SMB could be impacted more if we have some sort of recession. We don't really know what that looks like yet, right? So they provide software as a service, cloud-based payments, and spend management products, which allow users to automate accounts payable and accounts receivable transactions, as well as enable users to connect with their suppliers and customers. So part of this is going to be that software as a service, part is going to be usage or consumption type based. They also do offer implementation as well as consulting services, so it's not 100% SaaS. So this is hyper growth, and I'm bullish on the stock longer term. But I don't think it deserves as high of a valuation as some of these other companies that are more SaaS. Like Monday.com is 97% recurring revenue software as a service. Okay, so if I look at this stock, $114, I'm watching earnings, February 2nd. If this pulls back below $100, this is where I would look to add a position to Bill. All right, the fifth stock, guys, is Texas Instruments. The ticker is TXN. The PE ratio is at 18.43. It pays a nice dividend yield, 2.86%. This is a dividend growth type stock, kind of a hybrid DGI, DGIF. Market cap, $157 billion, so it's pretty large. Now, they just had earnings. Q4 GAAP EPS, $2.13. That was a beat of 15 cents. Revenue of $4.67 billion. Now, this was down negative 3.3% year over year, but it did beat by $40 million. Guidance. So Q1 2023 EPS, their guidance is a pretty wide range. We have a lot of uncertainty, especially with semiconductors and inventory still. $1.64 to $1.90. The estimate was $1.87. So that could come in the lower end. And then that revenue guidance, guys, is $4.17 billion to $4.53 billion. The estimate was $4.41 billion. So this also could come in a little bit light. So this guidance wasn't as strong as maybe the market would have liked it, and the stock did sell off a little bit. If you're not familiar with Texas Instruments, we design, manufacture, test, and sell analog and embedded semiconductors that help nearly 100,000 customers around the globe. Now they work in several different segments like industrial, automotive, personal electronics, communications, enterprise systems, and so on. Now you might remember, if you're old enough, like me at least, you might remember back in the day, you used scientific calculators. A lot of those were Texas Instruments calculators, but the company has evolved a lot since back then. This graph here just gives you an idea of their revenue by market. This was in 21, but industrial is about 41%, automotive 21%, and that is growing. Personal electronics is 24%, and so on. And here are some highlights from the recent earnings report. Now, revenue did decrease 11% sequentially and 3% from the same quarter a year ago, like I mentioned. Our results reflect weaker demand in all end markets with the exception of automotive. Now the question is, will that demand decline as well in 2023? But their cash flow from operations, guys, is $8.7 billion. Over the past year, they invested $3.4 billion in research and development. Now this is huge, guys. Now over the last 2 decades, TXN has bought back about half of its shares outstanding. This, together with continued growth and improved margins, has made, it's not EBITDA, but EBIT per share jump from negative 30 cents a share to $9.60 over that period. And here's a graph kind of showing that. Now that's pretty impressive over the last 20 years. You can see revenue per share has gone from $4.90 all the way to $19.70, and that EBIT per share, negative 32 cents all the way to $9.60. Number 6, guys, is Casey's General Store. This is trading around a 21 PE ratio. It does pay a dividend. It's a 0.66% dividend. This is a DGIF. Now, I have covered this stock on the channel a couple of times, but this is really a Midwest type of a company. It's a general store, so it's a convenience store. It's one of the largest pizza chains in the world. $10 billion total enterprise value, 16 states, 705 million guest transactions per year, 43,000 employees. Now, their footprint is very rural, and you can see the states on your screen. I do like this company, and they're growing quite a bit. You might be surprised. Check out the numbers. You might be surprised at the growth that you see from this company. This stock adds a little bit of diversification in the portfolio, a little bit of that safety stock. When you think of like a recessionary type stock, this is going to hold up better whether the environment's good or bad. People are still going to buy their gas, they're going to buy their cigarettes, they're going to buy their energy drinks, and so on. Check out Casey's. The ticker is CASY. So number 7 might be one of my favorite stocks that I don't actually own, and it's been on my watch list for quite a while. I started researching this stock when it was around $60 a share, and I've been very patient. It has pulled back nicely. It's now below $100. If you're not familiar with MGPI, smaller cap type stock. Now they're dealing with distilling solutions, branded spirits, as well as ingredient solutions. Now the 52-week high was $125. The 52-week low is $73.08. It's trading right now at $96.70. P ratio is a 17.85. It does pay a dividend. This is a DGIF stock. It pays you about a 0.5% dividend yield. It's a small cap, $2.08 billion. So you ask, Eric, why don't you just buy the stock? Yeah, it's back below $100. It's a 17.85 P ratio. One thing I've never really understood, and I just don't understand this, 16.84% short interest. So what am I missing here? I mean, this has been this way in Fidelity for a while, so I don't think it's a glitch or something like that. But I do like this company. I think personally, this is going to have earnings as well. So according to what I found online, February 23rd, MGPI is going to report earnings. Now, I'd love to see this stock at $75 in that level. I would be a buyer at that price. Real quick, guys, before I go on, I need to announce this video is sponsored by The Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/firedupwealth. You can also join our private community in Discord by visiting patreon.com/firedupwealth. Let's throw in some biotech. And I'll be honest with you guys, I am not an expert on this stock. I have not spent a lot of time on it. And it also is trading pretty much close at a 52-week high. The 52-week high was $324.75. It's trading just at $324. It has a PE ratio of a 25.25, which is pretty good considering its growth. It doesn't have a dividend, large cap, $82 billion. Now, before I buy this stock, I'm going to do some more homework, and I suggest you do the same. This Motley Fool article here has it as a buy and hold forever stock. Cystic fibrosis. There's 4 CF drugs currently treat around 65% of the estimated 88,000 CF patients worldwide. That's a pretty big number. It seems like a nice little monopoly or moat that it's kind of growing here, right? The reason why you want to own this stock for years is its pipeline. The company expects to launch 5 new products over the next 5 years, each of which has tremendous market potential. They include a cure for sickle cell disease, a replacement for opioid drugs, and so on. Don't be surprised if Vertex ranks among the biggest drug makers in the world in the not too distant future. This is one that I think deserves some attention from us. Let's dig into this, and maybe this is something that we could buy on a pullback. Now, if I had to choose between one stock, Nike or Lululemon, of course, I've owned Nike since 2010 or 12, and it's done really well for me. But I could argue that Lululemon could actually see more growth over the next 5 years compared to something like Nike. Of course, Nike has a dividend, and Lulu doesn't. This is trading at a 33 PE ratio. 52-week low is 250, so it's about $50 higher than that at 304. 52-week high was $410, and it was even higher than that if you zoom the chart out further. Now, the reason I have this on the list, Nike is actually suing Lululemon for footwear patent infringement. Okay, this could put pressure on the stock. I think if it goes below $300 again, it could be an opportunity to add the stock. Their last earnings report was pretty solid. They don't report again until the end of March. My wife just bought a mirror, and they own Mirror, of course, and she really loves the thing. I'm not saying that's a reason to buy the stock or anything, but being able to use that myself and see it, I think that's pretty cool, and it integrates into the ecosystem for Lululemon. So I know that there's a lot of people watching this that aren't going to be bullish on Lulu, but I'm telling you that this could actually have some growth, and it gives you some exposure into retail, maybe a different brand you're not aware of. At least do some homework on it. And if it dips below $300, especially if it gets closer to that $250 range again, I think it could be an opportunity as a long-term investor. So again, if you want to see my watch list with the price targets that I'm aiming to buy at and actually see my buys and sells in real time, join the Discord. It's patreon.com/firedupwealth. At a minimum, subscribe to the channel, click that bell for notifications, and drop a like and a comment. Last but not least, guys, stay tuned for this. The 10th stock pick is Intuitive Surgical, ISRG, and I did a deep dive on the channel not too long ago. Go check that video out right after this one's over. This is an expensive stock. PE ratio is 66. It doesn't pay a dividend. Market cap is around $85 billion. They also just recently reported earnings, and the non-GAAP EPS, $1.23, that missed by 2 cents. The revenue of $1.66 billion was only up 6.7% year over year and was in line with estimates. If you're not familiar with Intuitive Surgical, they do robotic assisted surgery. And here's one of Intuitive Surgical's Da Vinci machines right here on your screen. So here's some of the Q4 highlights, and I'm not going to read through all this. There's 2 things I want to point out on this, and you can read through on your own, pause the screen if you need to. So fourth quarter of 2021 also reflected COVID-19 disruptions later in the quarter. They had issues in the US, Europe, and China with this, and it impacted their procedures. And their compound annual growth rate, when you look at the fourth quarter between 2019 and 2022, is about 14%. The company, though, repurchased $1 billion of common stock in the fourth quarter of 2022. Here are the procedures in 2022. You can see there's growth there, 22% year-over-year growth, US general surgery, 18% year-over-year growth overall. Now, this is also key. This is from an analyst talking about the backdrop, saying that EPS will finally grow, and they think Intuitive Surgical will see procedure guidance improve through FY23. So this pullback could be an opportunity. So Stifel analysts also maintain a buy rating, and they raised their price from $285 to $300 a share, which of course analyst targets don't always mean anything. I like the stock a lot better when it's below $200. It's trading closer to $250 now. If this were to pull back, if the greater market pulls back, if this gets closer to $200, that's where I consider adding it to my personal portfolio. I don't currently own the stock. And last thing on Intuitive Surgical, they do have $6.74 billion in cash. I appreciate your guys' time and attention. Make sure you subscribe and click that bell for notifications. Drop a like, drop a comment. Have a great rest of your day. Take care.